The growth in cyber insurance is correlated to the amount of business conducted online, combined with the increase of internet availability and internet-connected devices. Cyber insurance has changed as the risk of cyber event has evolved. Earliest companies traced their cyber lineage back to the 1980s with protection of hardware such as mainframe computers and data on tapes. However, it wasn't until 2003 when California created the first data privacy law did modern cyber insurance take form, and the EU amplified data privacy when it passed GDPR regulations back in 2016 with an effective date of May 2018. The next major milestone came in 2017 with ransomware, in particular WannaCry and NotPetya. Ransomware not only attacked a company's data and reputation, but also business continuity. More recently, the Colonial Pipeline ransomware attack in 2021 highlighted the risk potential to threats on critical infrastructure. While this particular attack did not target operational technology systems of the pipeline, the lack of visibility into the OT architecture caused the pipeline to shut down, causing widespread chaos on the east coast of the United States and regulatory attention. The last thing to point out is regulation. It takes time for regulation to catch up to any new activity, let alone one that has the pace that is dynamic as cyber, but regulations are likely to have a profound impact on cyber risk and insurance. Market competition and recent proliferation of ransomware and other cyber incidents led to a sharp decline in cyber insurance profitability. Insurers have responded through a combination of price increases, tightening of terms and conditions, more stringent underwriting, risk management, and policy aggregation tools. While still increasing, the pace of increase of cyber insurance pricing is showing signs of moderation. Insurance companies are also requiring executive attestation of critical risk reduction components such as the use of multi-factor authentication, and even have rescinded policies where the attestations have proven false. It is estimated that at least 50% of all cyber premiums written are reinsured, and substantial net exposures to cyber events lies with the largest global reinsurers and Lloyd's. This reliance or potential over-reliance on reinsurance makes reinsurance capacity a potential limiting factor to the growth of the cyber insurance market. With the rising volume and dollar amount of cyber claims losses, reinsurers have responded with price increases and greater underwriting scrutiny, leading carriers to reassess reinsurance utilization. Protection against large cyber catastrophe losses are slowly emerging on other fronts. In early 2023, there was some cyber ILS market activity, but a limiting factor to a large cyber ILS market is uncertainty surrounding modeling of the cyber risk. War and terrorism events are typically excluded from insurance policies, but cyber contracts pose several challenges. The first challenge is cyber insurance contracts are not standardized and are constantly evolving. Second is the attribution of attack is significantly difficult to determine. Third, cyber is usually a component of a larger physical military response and often targets critical infrastructure such as financial services, governments, and utilities. Fourth is the unintended risk of an act, or what is commonly referred to as a spillover risk. The 2017 NotPetya attack is a great example of this risk. NotPetya was designed to target Ukrainian government and financial entities, but ultimately affected computer systems across the globe, costing billions of dollars in damages.